Hi, I'm Michael Taila, Director of Fixed Income at City National Rochdale, and welcome to this month's edition of Fixed Income Perspectives. During the first half of the year, bond markets went through elevated volatility as shifting tariff policy, geopolitical events, and federal fiscal uncertainty led to sharp moves in yields and valuations. But as we entered the third quarter, the interest rate environment is more stable. From a return perspective, it has already been a good year for major fixed income markets, which have delivered positive total return year to date. The one exception remains U.S. municipal bonds, which are still moving through the aftermath of trade policy and some unease around the administration's view of the tax exemption. Outside of the muni market, performance was supported by attractive yields, durable credit quality, and periodic demand for safe haven assets. The top performing fixed income segment has been global bonds, as a weakening in the US dollar helped boost performance. Both US domestic investment grade and high yield bonds have also rewarded investors with mid-single digit returns. Turning back to US municipal bonds. As I mentioned, this area of the fixed income market has lagged its peers this year. Municipals have underperformed due to a combination of trade policy risk, the potential loss of the tax exemption, and sudden technical events. While the weakness shows up in the top-line numbers, the repricing did not impact the market evenly. To illustrate this, when we observe the performance of specific maturities, inside of 15 years, munis have generated positive total returns this year, which contrasts with longer maturities that have been slower to recover from the rate volatility earlier in the year. But we think there are several positive catalysts. The recently signed reconciliation bill left the muni exemption intact, a risk that dampened demand earlier in the year, but is now likely to increase demand in the second half. Additionally, valuations are currently attractive. Long-term municipal yields are becoming more attractive as longer-term rates start to reflect the potential impact of tariffs and government policy. We believe this will improve the advantage of owning municipal bonds versus comparable U.S. Treasury securities for high-tax investors. Regarding U.S. Treasuries, the debt limit was raised by $5 trillion in the One Big Beautiful Bill. This now allows investors to refocus their attention away from the debt ceiling and towards anticipated Treasury supply needed to replenish low cash balances at the U.S. Treasury. As we can see from this chart, current cash of about $300 billion is projected to reach $500 billion by month end. Despite this uptick in supply, we anticipate investor demand to remain healthy as yields remain attractive versus other short-term market alternatives. So where does this leave us as we enter the back half of 2025? First, bond markets have been surprisingly resilient despite higher levels of uncertainty and volatility. For investment-grade municipal and corporate bond investors, yields remain compelling and credit conditions favorable. Within the high-yield markets, income opportunities are attractive. However, tight spreads argue for caution, making security selection and diversification important. While trends are encouraging, we continue monitoring market risks for signals that trade and other policies will impact inflation and economic growth. We expect this to play out in the coming months and maintain our outlook for 1 to 2 rate cuts by year-end, in line with the market and the FOMC. CNR also forecasts the U.S. 10-year Treasury to remain at fair value within the range of 4 to 4.5%. Thank you for watching this month's edition of Fixed Income Perspectives. Feel free to reach out if you have any questions.